In recent weeks, the price of gold has hit record highs on several occasions. On April 9th, 2024, the spot gold price surpassed $2,348 per ounce, reaching a high of $2,365.4 at one point, up 8.9% in a month and up about 15% so far this year. For some on Wall Street, the surge in the price of gold is expected to continue at least through the second half of 2024. Some analysts believe that the time-honored credibility and consensus are being awakened and gold is making a comeback. The fact that gold prices are soaring has Wall Street baffled. So, what are the forces behind it? Let's start with a look at the secrets of China's central banks. A UBS report pointed out that central banks continue to buy gold, and the net purchase in January and February 2024 was about 65 tons. China is now the largest buyer among central banks, having increased its gold reserves for 17 consecutive months as of March 2024, followed by Turkey and India. According to a recent report by an expert on China's gold market, Beijing has secretly hoarded more than 5,300 tons of gold, which is 2.4 times the official figure. Based on the figures reported by the World Gold Council minus officially reported purchases, this expert calculated that China's central bank, the People's Bank of China, PBOC, actually holds 5,358 tons of gold reserves, much higher than the published figure of 2,250 tons. In a March 21st article on the Gainesville Coins website, he claimed that China may be the driving force behind the recent rise in world gold prices, as Beijing begins to hoard gold to protect its economy from the depreciation of the US dollar. According to his estimates, China's central bank bought a record total of 735 tons of gold in 2023, which is 23% more than the record set in 2022, which was 597 tons. He stated that he had consulted with industry insiders and learned that the majority of China's unreported gold purchases were made by China's central bank. No one knows how much gold the central bank owns. It's one of the best-kept secrets in the financial world. He once wrote in detail about his estimating process for the amount of gold held by China's central bank. The growth of its gold reserves can't be captured by tracking the amount of gold mined or net imported into China, because virtually all of that gold is sold to the private sector through the Shanghai Gold Exchange. He said, China's central bank buys gold abroad in US dollars and then ships it to Beijing without leaving any trace in customs reports. There is only one way to find out how much the Chinese central bank is buying: through people in close contact with the banks and refineries that deal with China's central bank. In 2015, an industry source who worked for a major precious metals consulting firm shared a potential rule with this gold expert. The source said the Chinese central bank held about 3,300 tons of gold at that time. According to two other sources familiar with the matter who asked not to be named, the size of unreported central bank purchases can be used to assess the quarterly increments of the People's Bank of China, PBOC, and most of the unreported purchases are subscribed to by the PBOC. On a quarterly basis, the World Gold Council, WGA, publishes a total amount that shows how much gold is estimated to have been purchased by all central banks and international financial institutions. This estimate is based on public data and industry intelligence and includes both reported and unreported purchases. This expert on China's gold market explained that the WGA's quarterly estimates based on public data and industry intelligence are usually higher than the purchases reported by central banks, and the difference reflects unreported purchases. He said, in the absence of accurate data, I would guess that 80% of these unreported purchases are related to secret purchases by the People's Bank of China, and the anecdotal evidence convinces me that this is an appropriate percentage. He believes that Beijing's massive gold purchases over the past 2 years have fundamentally changed the world gold market, with the Chinese Communist Party or CCP taking over control of the price of gold from the West and driving the price of gold. Beijing's hoarding demand and private demand from Chinese investors who have abandoned traditional investment areas such as real estate and the stock market have been the driving force behind the rise in gold prices. He said that as China's real estate sector began to collapse at the end of 2021, Chinese people started to increase their purchases of gold, probably due to capital controls that leave Chinese investors with few places to invest other than the domestic stock market, real estate, and gold. So when both the stock and real estate markets are struggling, gold becomes more of a concern. Another reason could be that Beijing, concerned about the potential depreciation of the dollar in China's economy, is trying to gradually de-dollarize the country. That is, the People's Bank of China's strong and secretive gold purchases reflect an implicit de-dollarization. While the dollar remains the world's dominant reserve currency, China and other countries are trying to move away from it. So, will gold prices continue to rise? And where is the latest surge in gold buying taking place? It's taking place in the large futures and over-the-counter markets. It means institutional buyers, central banks, investment banks, pension funds, sovereign wealth funds are getting involved. Options trading activity is also on the rise, and the market is expecting the gold price to move further up as traders scramble to cover their exposures. In the past, world gold prices have responded to the market and have been more or less driven by the movement of the US 10-year Treasury rate. The price of gold tends to have an inverse relationship with interest rates. As interest rates fall, bond yields fall, making gold more attractive than fixed income assets such as bonds. Conversely, higher interest rates tend to reduce the attractiveness of gold because it doesn't pay any interest compared to bonds. And a stronger US dollar also reduces the attractiveness of gold. But this trend no longer exists. Recent strong economic data from the US has investors in the foreign exchange and bond markets betting that the Fed will cut interest rates at a later time and on a smaller scale than expected a few months ago. As a result, the rise in the price of gold has puzzled some market observers, especially as real interest rates in the US remain high, which is usually a drag on the price of gold. On the gold price surge, the current Wall Street gave a few explanations. First, the central banks return to gold as a reserve asset. Second, hedge funds are betting on the Fed's shift. The US bond yields are about to fall. Third, quantitative traders are attracted by the rising gold price. Fourth, the market is worried about the US inflation stubbornness and a hard landing. Fifth, global geopolitical risks and the unpredictable macroeconomic outlook, and so on. In the so-called safe haven market, investors are expected to flee riskier assets such as equities in favor of perceived safe haven assets such as gold and bonds. This means that investors tend to buy more gold before and during recessions and bear markets. On April 3, 2024, Peter Schiff, chief executive of Euro-Pacific Capital, said on his show, The Peter Schiff Show, that it's rare for gold to go up $30 overnight. Schiff, also known as Gold Bug, accurately predicted the 2008 US financial crisis. He said on his show that the movement of gold is a hint that the Fed's monetary policy may be wrong. In his opinion, the weak US dollar is the main driver behind the recent rise in gold prices, and the weakness is due to fiscal deficits and overprinting of money. As a result, demand for gold from central banks is strong, and gold is strengthening as a hedge against bad monetary policy. This view is shared by many overseas Chinese commentators. Currency overissuance is a serious problem. Since the epidemic, the US has printed a total of about $8 trillion, a roughly 40% increase in the global stock of US dollars. So that's a large number. The most observed consequence is that money isn't as good as it used to be. That $8 trillion is a long process if you want the market to digest it, and it's not likely to be over anytime soon. It'll inevitably lead to a sustained rise in the price of gold. A number of Chinese analysts hold a similar view that countries around the world have been quantitative easing over the past 2 years, with the US Treasury debt at over $30 trillion and M2 money at about $21 trillion. China has 290 trillion yuan, equivalent to US $40 trillion. Countries around the globe are over-issuing money, forming an atmosphere of currency depreciation expectations. It's the fundamental reason for the rise in the price of gold. China's website Tencent published an article on April 9th titled, "A Scary Reality Behind the Gold Surge." According to the article, China has entered an era of total excess, including overproduction and overqualified personnel. Most importantly, there is a currency excess. The author writes, "The excess currency has been temporarily stored by highly skilled financial institutions in various countries with various financial instruments, or is being dissipated by inflation. But a rate of monetary growth that far exceeds the rate of economic growth, no matter how technically manipulated, is excess money to the public. In an era of looming general excess, people are forced to embrace scarcity. How scarce is gold?
In
fact, the total amount of gold mined by mankind so far is about 200,000 tons, most of which were mined after the 1950s. What is the concept of 200,000 tons of gold? The specific gravity of gold is 19.32. That is, 1 cubic meter of gold is 19.32 tons. 200,000 tons is probably more than 10,000 cubic meters. In other words, a soccer field with a 1 meter high thickness can be packed with all the gold that we have now. According to the current gold price, it's about 13 trillion. Currency is only a measure of value, and it represents wealth. If there is no real value behind the currency, it will be devalued.
These Chinese analysts also believe that when gold rises to a certain level, the public will pursue silver. The price of silver will rise more in the next 2 to 3 years. Currently, everyone talks about buying gold in troubled times. In fact, it's the same for silver. When gold rises to a certain level where there is no gold to buy, or when people may not be able to afford gold, then they will go after silver. Gold and silver have a ratio. Currently, 1 ounce of gold is equivalent to the price of 88 ounces of silver. This ratio is relatively high, meaning that silver is relatively cheap and gold is relatively expensive. Historically, this ratio is in a relatively high position now, so when the price of gold goes up, people are going to pursue silver. To mention supply and demand again, in the future, the demand for silver will also increase dramatically because the new energy is now particularly hot. Batteries, solar cells, including solar panels, all need silver in large quantities, which is related to the properties of silver. Silver has excellent conductivity, and other metals are difficult to replace. With the development of new energy batteries, the demand for silver will soar. It's predicted that if the production of batteries and solar panels continues at the current rate, 80% of the silver stock will be depleted by 2026. One thing about silver, it's more of a byproduct. There are very few dedicated silver mines. More than 70% of it is a byproduct of other mining, such as copper, zinc, or gold. True, pure silver deposits account for less than 30% of all silver. Currently, the largest silver-producing country is Mexico. Mexico can achieve 20% of global silver production. However, due to Mexico's large amount of silver production, it's expected that by the end of 2025, Mexico's silver may be all depleted. This is very fast. If 20% of the world's silver is gone, then the supply of silver will fall greatly. So, in terms of the supply side, I think silver is going to go up just as much. The Chinese public expects to preserve the value of their assets by buying gold, but there are just too many pitfalls in the red country. For example, we previously reported this story. Several franchises of Shandong Gold, a Chinese state-owned company, and China Gold, a centralized company, were suddenly vacated, with customers' consigned gold disappearing along with the stores, resulting in a cumulative loss of more than 400 million yuan, or more than 55 million. Those gold investors who had deposited their gold bullion in these stores in the past few years were promised that they could take their gold out at any time. China Gold said that the headquarters does not allow franchises to start the escrow business. It's willing to report to the police to assist in the investigation and communicate with the franchises concerning compensation, but it's not willing to bear the compensation directly. The franchises promised an annual return of about 2.5% in addition to safeguarding the gold, which was comparable to value preservation and appreciation. Many customers were attracted, but they didn't expect such a drastic situation. The CCP doesn't want the public to have more access to gold either. Shenzhen's Public Security Department has posted a notice that a real name registration system for gold transactions should be strictly implemented, and that for transactions totaling more than RMB 20,000 in the same day, the purchase and sale of gold and other precious metals should be registered in real name. and that the merchant should ensure that the name of the bank card account used by the purchaser is the same as the identity card of the purchaser. Of course, it's done in the name of preventing fraud.
China's central bank now has about 2,000 tons of gold reserves, ranked 6th in the world. Gold in mainland China is basically controlled by the government, and the private gold is relatively small. In 1949, when the CCP took power, it ordered the seizure of private gold across the country. Each Chinese couldn't have more than 2 taels of gold. The rest would have to be sold to the CCP at a low price, which was 70% of the market price. This coercive measure was actually a great robbery. At that time, personal possession of gold was a felony in China. As we knew when we were young, gold was considered a strategic material. If it was discovered to own gold privately, not only was the gold confiscated, but other family assets would also be confiscated, and a felony conviction would be made. Gold in China was a monopoly. Other than some small gold mines, gold is basically mined by the state, and there is a specialized police department to supervise it, which used to be called the Armed Police Gold Force. Several of my classmates were assigned to the Armed Police Gold Mining Unit, and they worked on equipment. China's civilian gold is very little, while other countries have a lot of gold in civilian possession. For example, India's central bank holds more than 600 tons of gold, but India's civilian gold may be as much as 15,000 tons, a very different ratio from China's.
Of course, quite a few well-known investors hold a different view on gold. Billionaire investor and Berkshire Hathaway chairman Warren Buffett's view is that gold may be an appropriate way to diversify, but not as a major component of a portfolio. In a 2011 letter to shareholders, Buffett pointed out that for the price of buying all the gold in the world, an investor could buy all the farmland in the US and have enough money left over to buy 16 times the stock of ExxonMobil. The payoff a century later would be a bumper crop and plenty of dividends. The alternative is still just a lot of gold. But in the long run, it's better to own assets that can grow at a compound interest rate and generate returns. Buffett wrote in 2011, "True, gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end."